Everything in this video is not intended as financial or investment advice and is for educational purposes only. I'm Josh Olszewicz, the head of research at Valkyrie. Let's take a look at the midweek market update. I always like to start with on-chain activity of kind of everything, because even though it doesn't explicitly lay out utility, it does give you an idea. Are people actually using this stuff? It doesn't tell you what people are using it for. Specifically, what comes to mind immediately is stablecoins, because you see a ton of on-chain volume, which means volume on blockchains, not trading volume on exchanges, but physically moving around on blockchains for stablecoins. Still, it's one of the charts amongst everything that I'm about to show you that is moving up and to the right instead of down and to the right over the last couple months. And this, for many people, signals there's still a lot of dollars floating around in the ecosystem, in the pipes of crypto, whether it's getting yield or just sitting on exchanges waiting to be deployed or moving around in DeFi, whatever it is. We're still seeing roughly 750 billion on-chain volume. And this is curated, which means it's adjusted, which means it's not just fake volume. One of the reasons why I don't talk about volume a lot for crypto products is because it's oftentimes hard to know what's quote unquote real, what's wash volume. This stuff happens on certain products. What's bot activity, for example, right? And when you're looking at on-chain values specifically, there's a cost to moving that around, whereas on exchanges, there isn't always a trading fee associated with that. So just some caveats on why to look at this type of data versus other types of volume data. But nonetheless, across the board, we are seeing just a ton of demand for stablecoins. Now you could say, well, maybe this is related to unrest globally in various degrees in various countries. Maybe it's due to lack of trust of various institutions in various countries. We saw this certainly with the Ukraine-Russia stuff, conflict, war that's happening now, and people exiting the country using anything they could, including stablecoins, to move money around, donations in stablecoins to Ukrainian causes. And it's important to also note that all of these are USD backed, essentially. We can argue about the backing and the types of backing and how much of this is quote unquote real and what you've seen in the press. But at the end of the day, most of the backing for this stuff is US treasuries. USDC, GUSD, Tether. Tether came out this week and said 53 or 58% of their backing unaudited is treasuries, US treasuries. So stablecoins continue to grow. Stablecoins continue to sit in the system. Like I said, USDC, a slight anomaly. So I was going through today and thinking, okay, what happened with USDC here that it really reversed course? Now, if you may remember, a few months back, there were articles after article about all these people shorting Tether. They're sure Tether is going to fail. They can't wait to see Tether go to zero. All the while, Luna UST collapsed on May 11th. So after May 11th, you're seeing this flight from Tether to USDC, and then the Tornado Cash OFAC sanctions hit on August 8th. And really from there, Tether has flat or grown slightly on-chain relative to USDC, which has continued to decline in circulating supply. And now it's even lower than it was in May. Now you could argue, looking at this, that the reason USDC had this double top type of fractal was because of Terra. It's because of people fleeing from one stablecoin to another, or a perceived flight to safety, right? And post OFAC, you could argue there's a perceived flight to safety from USDC to Tether, perhaps, for some people. Add on to this, recently Binance announcing an auto conversion of non-Tether stablecoins on the platform to BUSD, and you can understand the rise in BUSD here in the blue relative to USDC. In the green here on the bottom, you have Gemini, which in the grand scheme of things, GUSD, a very, very minimal player compared to the billions held by Circle and Tether. But the point of all of this is to say, look, even though there has been a significant shifting of the guard post Luna UST, we still have billions upon billions of stablecoins sitting in the ecosystem. So not only is there dry powder just in the periphery but there's literally dry powder in the ecosystem. One other thing about Circle I noticed today was they've dropped rates again from 0.5% to 0.25%. And that could be for a variety of reasons. Most of the rates are generated through Genesis. If there were some issues there with that partnership or with Genesis, I'm not speculating that there is. It's just that's potentially why this rate would drop here. So it makes sense to me that with yield dropping, especially relative to inflation in the US and globally, that there's less of a demand for USDC. Not only that, but yields in DeFi, yields elsewhere are down significantly from historic levels. And you generally see that in a bear market versus a bull market, where you see people looking to deploy and borrow stablecoin. So everything sort of makes sense if you put all the pieces together. And even still, there's a bunch of stablecoins sitting in the system. Now, if we look at BTC and ETH, again, these are sort of the reason I talk about active addresses and transaction counts. It's a way to see on-chain who is paying to move this stuff around, with the assumption that there's utility built into this, right? Because it costs you to move this stuff around. Whether this is retail, whether this is institutional, whether this is remittances, you can tear that apart or look at that in different ways. But all of this encompasses those different people, different aspects, which is why I like looking at active addresses and transaction counts. But for BTC, mainly flat. This is the monthly average here, 90-day average, sorry. Mainly flat, rising slightly on average, right? And if you zoom in on this stuff in like a weekly basis, right, it gets kind of noisy. It's really hard to say in a micro level what's going on here, which is why I like to zoom out 30 days, 90 days. Flat, slightly rising on high time frames. Another way to look at general activity and who's paying for this is transaction fees. Transaction fees are based on your need and want to get into the next block, okay? This is generally for any blockchain. So if there are a bunch of people looking to get in that elevator, right, and they're willing to pay more to skip the line, you're going to see transaction fees rising. And during bullish periods, that's what you see. You see more activity on chain, you see fees rising. During bearish periods, arguably like we are in now, you see fees less excited, flat, down. This isn't unique to Bitcoin across all digital assets. For the most part, on-chain activity declining or flat. The good news here is that these transaction levels are so flat that when this does start to pick up again, it's going to be fairly easy to see it happening. It's a desert out there when it comes to transaction fees. So when it starts to rain, when it's misting, when there's at least dew in the morning, we will know. We will know what's going on here very, very quickly when transaction fees and activity start to pick up again. Now, we can also compare Bitcoin and Ethereum, looking at on-chain volume. You can compare this coin to this coin to this coin. You can try to do apples to apples. You can say, okay, there's a value proposition here on Solana relative to Ethereum, or you can try to build a case based on on-chain activity. But again, for the most part, all these assets are down and to the right. Now, arguably, they're sitting at previous all-time highs of on-chain activity. This is a 7-day average for volume, notional volume specifically. So we're still moving 6.3 billion on a weekly average on Bitcoin. We're moving 2.7 billion on a weekly average on ETH. You can see that's still trending down. Again, it's going to be obvious when this stuff picks up again, just like it was obvious in previous post-bear market periods. And it makes sense that prices are as quiet as they are, as flat as they are, relative to this on-chain activity, because these things do go hand in hand. BTC and ETH on exchanges as well, another sort of proxy for, okay, what are people doing with their crypto or their digital assets? Are they depositing them to sell? Because typically that's what you do when you send them to exchanges. This is mainly flat, so this doesn't signal a large run to the exits for people who are still here in the digital asset ecosystem. And if we want to take this a step further and look at days destroyed, the idea here being if you're holding one BTC and you hold it for 365 days, that represents 365 days, right? So if you then move that, you destroy 365 days. If you move it for any reason, if you move it from wallet to wallet, if you move it to sell, if you move it because you're buying something, anything whatsoever, that's going to get picked up in this this signal or this measure here, this indicator. And we can see coin days destroyed for Bitcoin is effectively, this is a 90-day average here, but it's effectively at 2010 levels of inactivity when it comes to holders cashing out is another way to think about this metric. Holders tend to cash out at market highs because they have unrealized profits effectively, right? And we see this over and over again, mainly at highs, sometimes at lows. So if price does break a low, not necessarily an expectation, but if it does, then I would expect this indicator to shoot up like a rocket, right? Because then you're going to have people cracking their cold storage, as we say, looking to move those coins to exchanges. But as we sit here currently, holders are still hodling. They have no intention, by the looks of it, of moving coins around to sell. So just another way to check sentiment and to see what are the people here doing with their tokens, right? Now, if we look at ETH post-merge, merge was around, August 15th, something thereabout? Sorry, September 15th, right? These months starting to blur together. But nevertheless, ETH's on-chain activity roughly flat since the beginning of 2021. Peaks and troughs, sure. Still relatively at the same level of the previous all-time high, which is good. We're not seeing a massive peak and trough every cycle, which tells me, okay, yes, there's a lot of speculation here, but there's still people here doing stuff, right? We're seeing on-chain activity, transaction counts in the millions still, 1 million to be specific, but it's not 2017 where we're seeing under 100,000 transactions a day, right? This is a different blockchain entirely. So some of that valuation, to me, is justified based on on-chain activity. Nevertheless, still flat, relatively. It's hard to understand a lot of this on a micro level, but zooming out, if you zoom out more and more and more, essentially it's just been flat. What we'd certainly like to see in the next cycle is a continued push of on-chain activity across the board, right? Because that represents continued utility, not only speculation, but continued utility of these blockchains. Ethereum's fees as well, almost breathtakingly, staggeringly at levels that we have not seen since really just post-COVID or around COVID, March 2020. Now, this isn't because scaling got better. This isn't because the merge fixed everything. This is because on a relative basis, transactional activity on the chain is down significantly. We had DeFi previously, we had NFTs previously. That activity, which I'm about to show you in a second, is essentially declining or flat, right? And you can say, well, that's bearish, but you can also think of it as once this starts to pick up again, which it most certainly will. I don't know what the next big use case or utility will be. I certainly didn't predict NFTs, but one thing to watch is definitely transaction fees, if and when they start to pick up again with activity. And one of the reasons that's so important is because ETH has a fee burning mechanism, meaning if fees reach a certain level, a percentage of that fee is burned, is removed from circulation. So this is how issuance is offset in a big way, potentially in a deflationary way, if burning picks up in a big way. This big jump, this spike here, isn't noise. It was a NFT mint where, again, if you're trying to get onto that elevator and you're willing to pay for it, in this case, people were willing to shove people off. They were grabbing people out of the elevator and paying to pull them off the elevator, right? Because they wanted to get priority in that block so badly that they were willing to pay a significant amount of money. There are ways to prevent this. This is avoidable, but that's what happened, which is why the burn on that day spiked significantly. Thus far, specifically even post-merge, we're not seeing burning activity pick up. But this is one of the most important charts for ETH, again, because it shows you the utility component, arguably. It shows you a proxy for issuance as well, because if this starts rising, the assumption is that issuance starts going deflationary. The second most important chart for ETH are the validators, because validators currently also represent a supply soak. So right now, there's 14 million ETH being used to stake on the network through proof of stake. Currently, the stake plus the rewards are locked until the code is written and approved and implemented on the chain for those rewards to get unlocked along with this ETH. So it's effectively vested for an indeterminate amount of time, potentially 6 to 12 months. But it's important to watch this and it's important that this continues to grow because it's a supply soak. So if you're bullish on Ethereum, what you really want to see, not just on-chain activity, but you want to see the burning component pick up and remain steady. You also want to see validators pick up or continue to pick up as a percentage of the circulating supply, because that's removed from the circulating supply. The float is effectively reduced. And one way to sort of measure where this could go from a staking component is to look at ETH versus other stakeable assets or other stakeable chains. And let's just say conservatively 50%, an additional 50% on the staking ratio is possible here relative to where everything else is at 60, 70 as a percent. So that's another 60 million ETH being locked up potentially, right? The reason this is people aren't just rushing to do this is because, again, that ETH is locked up for an indeterminate amount of time, probably 6 to 12 months. So there's certainly some friction there, but it's something to watch for. If validators continue to tick up, certainly that would likely be more and more bullish for ETH at the end of the day, right? It may be a nothing burger right now, but when things start to pick up again, it'll certainly matter in a bigger way. It'll have an amplified effect. One of the things that is doing really well right now is ENS. ENS is a decentralized domain service on Ethereum. You can think of it as like a GoDaddy, where you can register a .eth domain, and you can see the monthly registrations are over 400,000, or were over 400,000 last month, which continues to just make highs. So there's a lot of activity, and this is one of the few avenues right now on ETH that is seeing growth and users and participation. 2.64 million DNSs or ENSs created on Ethereum. Now, if we look at NFTs, right, you've probably seen headlines about NFT volume dropping off significantly. The caveat here is, again, we're talking about volume. A lot of this was and is either bot volume, wash volume, not real volume, not saying that a lot of it was, but on some of these platforms, certainly there are incentives to create volume. So that's what happens. Volume is created. So this is certainly drastic and certainly noticeable, but again, it's at zero from infinity, right? So when this picks up a little bit, we will know if it does pick up again. DEX volume, not as drastic to the downside, but that has dropped slightly month over month. Most of this in the pink here is still Uniswap, one of the largest DEXs, and the mauve, I guess, or whatever color this is, the brown is Curve, which is a stablecoin DEX effectively, where you can trade kind of like in a Forex manner between stablecoins. That's really what it's most known for. And there have been more talks of decoupling. I don't want to jinx it, but I think we are starting to see more and more whiffs of digital assets, BTC ETH, pulling away from S&P, DXY, the VIX. This is just BTC against ETH. And one thing we've always noticed is in a bear market, things tend to correlate. And that was certainly true post 2022, right? Correlations effectively went back to an all-time high, 95% correlated between BTC and ETH. That has come off significantly as ETH merge has happened, and we're starting to see this safe haven BTC narrative pick up a little bit. Maybe not said explicitly out loud, but it looks like that's what's happening when we're talking about why these things are decoupling. It's a potential driver for a decoupling. It's too early to say we're decoupled. That's going to take months to see it proof in the pudding there, but we're starting to see it, and we can measure that. This is against the S&P now. Again, we were at all-time highs, so it's not going to be hard to pull back from this. Over 60% correlation on a 30-day. We're starting to drop down, right? We were at 80+% correlated on a 30-day correlation. Just kind of nuts as far as historically. We always said in digital, crypto, whatever you want to call us, that we were uncoupled, decorrelated from TradFi, and that was certainly the case. That hasn't been the case post-COVID, specifically in 2022, but it definitely was the case historically. And it may be the case again historically, right? This thing it's a chameleon. It's hard to point it down and say it's this, it's that, it's risk on, it's risk off. It's emerging markets, it's currency, right? It's a commodity. It's kind of everything all at once, everywhere, all the time. It just depends on how people are trading it. Against the dollar, DXY here, we're at kind of maximum inverse correlation. That has started to come off a little bit on the 30 and 90-day correlation here. Let's check the 180. Starting to come off a little bit, right? So we are slowly, it's early, but we are slowly, I'm looking for something, right? We are slowly starting to couple. This is the VIX. You can see over time, we're just more and more inverse to the VIX, slowly starting to relax on those correlations. Maybe not on the 180-day, but ultimately we want to be in digital asset land, decoupled from all this stuff. Let's move on to some TA stuff towards the back half here. I've been talking about the DXY, which is not dollar strength, but it's relative dollar strength. So against the euro, against a few other currencies in the basket. And it sort of made sense that we were gaining against the euro from a fundamental perspective. From a technical perspective, we were getting into trouble because we continued to have higher highs on lower momentum. We continued to have this parabolic upside that is just unsustainable from a technical perspective. And we are finally starting to see, again, I don't want to celebrate too soon here, but we are finally starting to see DXY relax. And the reason this is important is because we're so inversely correlated, or have been, to the DXY on the BTC side of things. So it makes sense that, yes, S&P may be doing worse than BTC, but more important, we held strong in DXY, just mega strength, right? And that's starting to come down. If we want to look for levels that this may pull back to, I think 108 and 103 are the key levels, just based on, this is called the Ichimoku cloud. And you can think of these kind of as moving averages, as well as Fibonacci retracement levels. And the cloud is hinting at these 108 and 103 levels. So those are the levels to watch in the next couple of weeks, certainly. GBP as well had that massive breakdown, just again, parabolic downside, not something that is sustainable, that you typically see, fundamental action taken to correct this ship, which is what happened with the UK government. But this has bounced significantly as well after last week's sort of dragonfly candlestick. And like I mentioned, I think last week, this is an inverted dragonfly or a shooting star type of candlestick. So the technical foreshadowing for these reversals was in the cards. On the BTC side of things, I know this is a busy chart, but if we put everything on the chart, right, if we get kind of pukey here with indicators and trend and everything, we're still below anything that I would consider for being bullish again, right? Any sort of litmus test, any MA, EMA, the cloud, right? No matter what we're looking at trend-wise, we're still below it, except we're starting to peak out of this downward channel, this pitchfork. So there's a little bit of good news there, right? We're starting to make the case stronger. We're early here. Again, we're super early, but we're starting to make the stronger case for this W double bottom type of chart pattern. And that may morph into some sort of ascending triangle or additional chart pattern down the road, right? But it's super early. The most important part, we didn't make lower lows. Great. Now what's next, right? What's next is what I'd like to see is a move to 25K. There's a lot of confluence at that level. The cloud, huge MAs there, 200-day, 200-week. There's a yearly pivot there, which is based on the highs and lows of the previous year, calculated on January 1st of this year. There's a ton of congestion in that area. So my guess is there will be some fight there to break that level. But if we do, I like closing out the year somewhere in the 30s. As we sit now, if I had to predict it, that's what the prediction would be. Somewhere we'd close December somewhere in the 30s. So this is what I'll be watching. Obviously, we cannot make lower lows. If we make lower lows, that's off the table. If we make lower lows, 25K goes out the window as far as expectations are concerned for resistance. But as we stand here, as we continue to slowly creep up in relative to legacy especially, things are looking okay, right? We're back above 20K again. ETH, my read is a little less strong because we're still in this downward channel. We're still kind of in between MAs all over the place in the cloud, right? For ETH, I would love to get back above 1600. All I'm really looking at here is trend metrics. If we can get back above the 200-day, let's say the 200-day drops down to 1750 or something, then things can start to look more bullish. But right now, if anything, we're still bearish, neutral. Nothing's really changed on that front. And, when we augment all of this TA stuff with on-chain activity, it's not a surprise that you're not seeing excitement in the price here because on-chain activity is flattened down, right? But if that was the opposite, if on-chain activity started to pick up again for whatever reason, then that would add to the confidence of the trend flipping here. One thing that is doing quite well, Binance USD, which is the exchange Binance, their coin, their token, this is the kind of thing you want to see from a trend perspective. And you could even say, well, this is pretty noisy. You're going in and out of the cloud here. Ideally, what you want to see is something that's above the cloud, something that's below the cloud. Just stupid, simple trend metrics, litmus test, and we can go to a higher time frame, in this case, the 2-day, and say, okay, 325, above 325, we can start to get bullish again. Right now, it's still sort of in the wishy-washy zone, but this is outperforming BTC. Against BTC, it's outperforming ETH, I'm pretty sure. So it's doing quite well, kind of quietly, against other larger cap coins. If I look at the on-chain activity for BNB, you don't quite see the reasoning and rationale that you'd want for outperformance. There's still activity, sure, but it's not week over week, it's not rising. Lastly, something a lot of people are watching is ETH BTC, because there's this expectation that with ETH's issuance model currently, it should easily outperform BTC. And I guess the caveat to that is, well, like I said, if there are no burns, if validators are only just sort of trickling in, that supply reduction, that supply soak, may take some time to kick in. So this does look bullish still, but it is not outperforming BTC in a wide margin, right? So I'll leave it there for this week. Let me know what you think in the comments below. Like, dislike, share, subscribe, and happy trading.